bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 17th, 2023 podcast. This is most certainly likely coincidental, but the last time that this podcast guest was on the show marked our 800th episode of Tax Credit Tuesday. Today, he's back on what is Novogradac's 34th anniversary as a firm to the day, to October 17th, formed back in 1989. For those of you watching this episode on YouTube, you'll see a 34th anniversary background behind me. And for those of you listening to the podcast, well, you'll have to take my word for it or go see the YouTube version of this podcast. On behalf of my partners and myself, please let me take a moment and thank all of our Novogradac clients and all of our colleagues over the years. And we do look forward to many more years of working together with all of you to make America a greener, better housed, more equitable place. Now, on to our podcast topic of the week. Today's episode is our second installment in our Renewable Energy Tax Credit Finance series. My partner, as you've most certainly guessed by now, is Tony Grapponi. Our topic today has one overarching theme, broken down into two acts. The theme is year-end financial reporting recommended practices. And we're going to tackle this theme in two phases. First, we're going to discuss tax and financial reporting recommended practices so you can set yourself up for success during the post-closing phase of your development. For example, we're going to touch on deficit restoration obligations, or DROs, which can come into play if capital accounts are too low to support intended loss allocations. And if you don't know what I just said, you will really want to be listening to this podcast. We'll also discuss commonly misunderstood differences between what costs you can capitalize versus what costs you must expense. All of this falls under our tax and financial reporting portion of the episode. Now, the second part of the discussion will be tips for once your facility is up and running. We have several important issues you should consider during the operations phase. And really, while you have to consider it during the operations phase, you really need to consider this during the closing phase so you can anticipate what's going to occur during the operations phase. These issues include asset retirement obligations, or AROs, right of use assets, or ROUs, as well as the hypothetical liquidation of book value method of GAAP accounting, or HLBV. There's also assorted GAAP and tax differences that we're going to discuss, such as depreciation and amortization. And there are also state and local tax considerations we're going to cover. On a side note, before we get started, I do want to invite all of you to join us at the Novogradac 2023 Fall Renewable Energy and Environmental Tax Credit Conference. It's going to be held in Washington, D.C. on November 2nd and 3rd. Now, Tony is the chair of that conference, and we'll discuss more renewable energy hot topics at that event. So we certainly want you to join us and not miss out. And if you do attend, please take a moment to say hi to Tony and to me. We always enjoy welcoming attendees. I'll include a registration link in today's show notes. You can also go to www.novoco.com/events to sign up. I will also note that if you do register for the conference, download the Novogradac app in advance. You can chat or send an email to Tony and me so that we'll know that you're coming and we'll make sure that we say hello. We have a lot of ground to cover today. So if you're ready, let's get started. So Tony, welcome back to Tax Credit Tuesday. I'm excited to have you back for our second installment.
I love it. I love it.
Finance series.
Yeah, thanks, Mike. I appreciate it. And it's an honor to be here on such a notable occasion. And congratulations to you for reaching the 34th, anniversary of the firm.
Well, congratulations to you for making it all possible and all the contributions you've made over the years.
Thank you.
So I mentioned that you're the chair of our upcoming Renewable Energy Tax Credit Conference. And to our listeners, Tony's also a frequent guest of Tax Credit Tuesday, a contributor to the Novogradac Journal Tax Credits, and he's also a speaker at other renewable energy events. That said, Tony, I'm sure many of our listeners have met you before, or at least familiar with your work, but I'm sure there are some that haven't worked with you yet, or there are parts of your experience they don't know about. So please share a bit more about the work you do for renewable energy clients.
Great. Thanks, Mike. Yeah, so I help oversee, three broad levels of services here at the firm. So that first sort of silo of services, if you will, is really geared towards like transaction advisory or consulting type services. Okay. Those are like front end transactional services usually. As you know, many tax equity investors require a CPA firm to help run a financial model or to perform cost segregation studies or related consulting services along those lines. And so we do a lot of, so we've got one group that really focuses on those transaction related services, running deal models and doing cost segs. The next silo of services has to do with financial statement audit services. And so we've got teams of folks over here that's really all they do for the most part is focus on financial statement audits and those types of services. And then of course, we have another silo that does tax compliance related work, so preparing tax returns for transactions. And then obviously there's a bunch of other related consulting services from helping clients run HLBV models to helping them with mergers and acquisitions or buy sell transactions, et cetera. So that's kind of the overview. We offer a lot of stuff to pretty much anything to all the renewable energy industry clients out there. We love sort of helping them with whatever they need.
Great. Thank you, Tony. I appreciate that overview. And to our listeners and viewers, if you do work in renewable energy or interested in getting started in renewable energy, I do encourage you to contact Tony. He and his team, as he just expressed, have a lot of expertise in renewable energy financing. And I will include Tony's contact information in today's show notes, which are posted at www.novoco.com/podcast. So Tony, now let's jump into our discussion for the day. Part one of the discussion is going to be on post-closing tax and financial reporting tips. So I mentioned deficit restoration obligations or DROs. So I figured we'll start there. So for starters, if you could explain to our listeners what a DRO is, and then more importantly, when a partnership might consider a DRO.
Great, sure. So DRO stands for Deficit Restoration Obligation. It's really more of a tax concept than anything. And so what a deficit restoration obligation is, it's when a partner agrees that they will restore a deficit in their capital account on or before the time that they actually exit the partnership. It's a it's a legal arrangement where the partner says, if my capital account is negative, I agree that before I exit the partnership, I will bring that capital account back to at least zero on or before the time that I exit the partnership. Now, why is that helpful or why is that important? Well, a partner, oftentimes in this case here, I'm really thinking of a tax equity investor. A tax equity investor may not have funded all of their intended capital contributions into the partnership. Okay. And I'm really think of solar facilities that are placed in service sort of late in the year, Q4. Okay. When the facility is placed in service, especially I'm thinking of an ITC deal. With ITC transactions, there's this concept of what's called an ITC basis reduction. So the facility gets placed in service, an ITC basis reduction gets applied. And when that ITC basis reduction gets applied, it reduces both depreciable basis of the partnership's assets as well as the partner capital accounts. Okay. And so when that happens, you can have an investor member whose capital account is all of a sudden reduced to a point where it's particularly low. And it might make it difficult for the partnership to then go and allocate that partner the amount of tax losses they were expecting to get. Okay, again, meanwhile, the investor hasn't funded all of their capital contributions. Let's imagine now that the partnership hasn't satisfied all of those capital contribution funding requirements. And so now the year is going to close. That last capital contribution hasn't come in. The investor's capital account is low, too low to be allocated the losses. Well, if the partner thinks that that's going to happen, then that investor may want to consider agreeing to a DRO, a deficit restoration obligation. That DRO, the IRS says, if the partner has a DRO, that's a contractual arrangement that the IRS will respect for purposes of allocating that partner losses. Okay, so that DRO can actually help support a capital account that's either that's negative. And so if that investor signs up for a DRO, even though they don't have sufficient capital invested in the deal, the IRS will actually respect that loss allocation to that partner. So that DRO can support a negative capital account. If that DRO doesn't take place, then it could actually result in the partnership not being able to allocate the investor the expected losses. And then those losses might get inadvertently reallocated over to the sponsor or some other partner in the partnership. So, and if that happens, then that can really negatively impact the investor's yield. So DRO plays an important part in ensuring that the investor gets the losses that they negotiated for.
That's a good explanation, Tony. And only that I would sort of add to that is when I think about the DRO, I think about the the reason why it exists as a concept is the IRS wants to ensure that whoever's allocated the loss suffers the economic effect of the loss. And if you liquidate corporate capital accounts and positive capital account, you can be allocated the loss and capital account goes down. So you're suffering the economic burden of that loss. And if you're going to go past zero, you wouldn't really suffer the economic cost of that loss unless you had to fund that negative capital account in the event that the partnership liquidated when your capital account was negative. And then obviously the investors don't expect that to happen. They expect that they'll be making their capital contribution at some future date, and then their capital account will go back positive such that the deficit restoration obligation will never be triggered. But with that as an additional sort of background, if you could share with our listeners some of the tax and financial reporting considerations when a partnership does use a DRO.
Great, sure. Yeah, so definitely more of a tax reporting matter than financial reporting aspect. But so the thing you want to worry about here is if you're a sponsor, you want to make sure you get that DRO in place. We're in Q4. The parties have a lot of things going on in their business, and sometimes administratively this can get overlooked. And so from a communication standpoint, what you really want to do is you want to make sure that as a sponsor and an investor that you're having this communication in place. You're trying to size your DRO. So what I recommend that sponsors in the deal reach out to their investor and say, look, as part of our tax planning, let's look at our capital account levels to ensure your capital account is sufficient to be allocated the loss. If not, let's contemplate whether or not a DRO makes sense for you. Okay. Now, Novogradac, we oftentimes get asked to help our clients do that analysis. So then typically the sponsor investor will circle back to Novogradac and say, we're trying to do a DRO analysis. Novogradac, can you help us estimate what our tax loss looks like for the year? And can you also help us do some tax capital account calculations to help us figure out how much DRO we might want to consider in our transaction? So I like to encourage people, especially Q4, reach out and start that conversation about getting that DRO analysis going. And we can help you with that. Get some email traffic going. Show your intent. And then once you get closer to figuring out what your DRO amount might be, then work with your attorneys to get the contractual language in place to make sure you're in a good spot with your DRO.
So when you said figure out what the DRO amount is, you're kind of implying that it's a limited DRO, not a open-ended DRO. So maybe you could unpack that a bit.
Sure. Investors see value in DRO so they can ensure they get the losses they want to be allocated. That being said, they're also sensitive to, what's their maximum exposure to a DRO. Because at the end of the day, when an investor signs that DRO, they really are agreeing to restore that negative capital count. And so they usually don't want some open-ended amount to their DRO. So they want that DRO to have an amount assigned to it. So they want to feel like there's some sort of limit, if you will, or they at least want to have an idea of how much they're actually going to be required to restore if they were to get out of the partnership.
Right. Basically, the amount of losses that they were expect to be allocated or expect to be allocated, make the DRO up to that level. That's me
Right.
and that's your limit. And then if it turned out you needed to revisit that a year later, which normally you don't, then you can always revisit it a year later.
I appreciate you bringing up that part. I appreciate you bringing that tag along comment about usually they don't, right? Because I think what you're alluding to there is these DROs are oftentimes beneficial at the end of year one when that investor hasn't made a capital contribution that they were already planning on making. And so it hasn't come in yet as of year end. They sign up for a DRO. Once all final funding criteria have been satisfied, the investor finally makes that final installment, and they've kind of, in essence, restored their capital account, and they no longer need the DRO.
So under the same umbrella of post-closing issues, what are some common mistakes that you see among sponsors when it comes to capitalizing versus expensing costs? If you expense costs, you create tax losses. If you're capitalizing a cost, depending upon what it's capitalized to, it might mean more tax credits. But if you could share some examples of costs that, are commonly initially misclassified.
Sure, sure. You nailed it. A lot of our clients, especially when they're new to this, okay, they're thinking, just like you alluded to, they're thinking expense, 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 right? Because they want tax deductions. And if they're new to tax credits, they forget that if it's a tax credit deal, you want to elect to capitalize all your construction and development costs to increase your tax credit basis to get the credits to be as high as possible. So initially, for people who are new to this, it's a little counterintuitive for them to capitalize costs. They usually want to expense as much as they possibly can. Examples of costs that they might expense: overhead, carrying costs, payroll, things of this nature. They're normally used to just expensing. Okay. And so one thing we try to say to them is, look, your agreements contemplated you making elections to capitalize your carrying costs. So, make sure you just put them on your balance sheet. At the end of the day, it increases the chances that you're going to have a higher tax credit.
Right. And if you think about the expensive versus capitalizing, maybe you just do the math briefly for listeners. When you think of $1 of expensing, if you're at a corporate tax, you're at 21%. Maybe I'll end up doing it while I'm explaining the question. Get $1 in tax losses, that would save a corporate investor 21 cents. If you had $1 that was capitalized, it'd be 30% of, say, an ITC deal. You get $30 in tax credits, and then you're going to end up having a basis reduction for half of the 30 cents. So then you're going to have a 15-cent basis reduction, so 85 cents left. And then that could end up being expensed such that you get a 21% on that. So you're going to get like 46 plus cents of sort of tax benefit versus 21. And you don't have to be the
Correct.
accountant to know 46 is more than 21.
Exactly. Yeah, and the credit you monetize oftentimes at more than even $1 per credit, depending on your arrangement with your investor.
Right.
So
That dollar is monetized at a higher rate because you get the credits, you get the tax losses with a 50% basis reduction, and then you also have some level of cash flow. And those three together end up being more than $1. Is that generally accurate?
that is generally accurate, and I like how this is like a little bit of a teaser for our next podcast, because we've got a podcast coming up again in a few weeks on unpacking investor benefits. And so that's a little bit of a teaser for our next podcast. But yes, that's generally accurate.
So now let's turn to part two of the discussion, and that's tips for after your facility is in place in service and begins operations. Now, when you and I prepared for this podcast, we identified, let me emphasize, this is a non-exhaustive list. We identified 5 issues that listeners should be particularly sensitive to. So I wanted to just kind of go down the list. And number 1 was asset retirement obligations, or AROs. So you could first describe for our listeners what an ARO is, and then what they should know about them.
Sure. Sure. So an ARO is very much a gap issue. It's a non-tax concept. It applies to generally accepted accounting principles. And it's a non-economic type of activity. A great example of when an ARO comes into play for a renewable energy facility is with a site lease agreement. Most of our renewable energy clients, they don't own the land that their facilities operate from. They lease the land from where the facilities are located. Those lease agreements oftentimes have a clause in them that require the sponsor, or the lessee in this case, the lessee of the land, to restore the land back to the condition it was in before they built the facility. Okay. When your lease agreement has that clause in it, it triggers what's called an asset retirement obligation and for GAAP purposes. And in essence, what those rules require you to do for financial reporting purposes is to calculate, do an assessment of how much it might cost you to remove that plant at the end of the lease term. And then they want you to record that liability on your balance sheet, and then essentially over the lease term accrete that obligation to what the obligation will be at the time your lease expires and you need to remove the facility. Okay. And so this again, our clients are excellent at accounting for all the cash economic activity of the partnership. This is a non-economic transaction, And this is an area where our clients oftentimes book last, okay? Or they get to it when they get to it. And one thing part of the theme here with these year-end financial reporting tips, Mike, is to help our clients get their books and records as complete as they possibly can be at year end to get their year-end financial statement audit and tax reporting off to the best start it can get. Okay. And this is just one of those items that a client tends to look at last, or even they send in as a post-closing type of like entry after they send us their initial books and records. So what I like to tell them is, look, it's Q4. Reach out to your audit team. If you're confused or you need some clarity on how to record your ARO, reach out to us. Have a conversation about your AROs, and we can help guide you a bit so that you can put you in a better position to get those AROs recorded.
So thank you for that. And that's really a theme of other podcasts this time of the year is do as much as you can before year end to avoid issues, as well as to prepare yourself for easier tax filing and audit season. So thank you for that about AROs. And now let's talk about ROUs, or right of use assets. If you could explain to the listeners what a right of use asset is and what they should be thinking about as we approach year end.
Right. So right of use assets and corresponding liabilities are, again, it came out as part of this came out last year. I don't know if folks remember this, but it's ASC 842. Again, we're back into the leasing world, and you've got lease obligations, and you're supposed to figure out what the corresponding right of use asset is associated with that lease. And GAAP requires that you book that right of use asset on your balance sheet. And so, again, our clients look at that activity and they see it as a non-economic type of GAAP accounting. And so, again, a lot of our clients are for privately held companies that came into effect for the 2022 year. And so a lot of our clients have been doing this for, many years. They went through the analysis last year and they booked those right of use assets and corresponding liabilities. But it's amazing how many new entrants there are to the marketplace. You think of the Inflation Reduction Act, all of a sudden we've seen a lot of new entrants here. And so we're working with a lot of new clients that they're building facilities, they don't have any operating assets, and they're trying to go through this for the first time. And so one thing I'd like to encourage them is, again, before you close your books and records at the end of the year, reach out to us. We've got a colleague on my team by the name of Nick Ives who's helped many clients with their right of use asset calculations, helping them read the guidance and get those recorded.
Great. Thank you, Tony. So number 3 on the list that we developed during the preparation for the podcast was tips regarding the hypothetical liquidation of book value method of GAAP accounting. It goes by the initialism HLBV, and HLBV is an accounting methodology that a partner would end up using to determine their GAAP earnings for a given year. And basically, the HLBV method is what its name says it is. You have to hypothetically run calculations and hypothetically liquidate the partnership at book value and see what your relative capital accounts are. And then you use that to report the GAAP earnings and other aspects of your financial reporting. So Tony, if you could maybe better explain HLBV
Right.
and share what it is that you think listeners should be aware of when they're contemplating HLBV.
Yeah, so I'm glad you stressed hypothetical, right? Because that's a one area. HLBV confuses a lot of people in the industry, especially our clients. And a lot of times they just hear liquidation. They hear liquidation. And they think, what are you talking about? We're not liquidating anything. But so we have to kind of remind them this is a hypothetical liquidation exercise. And it's for GAAP. Again, this is a GAAP concept. It's not necessarily tax, doesn't really come into play with your tax results, but it's a GAAP issue. HLBV it's a complicated area of guidance under GAAP. The purpose is to figure out how you share earnings, GAAP earnings between your non-controlling interest member. And when I say non-controlling interest member, I'm referring to your typically, the typical scenario involves your tax equity investor, okay, in a partnership flip arrangement. Okay, so if you have a partnership This could be a regular single entity partnership flip, or it could even be an inverted lease structure where you've got the master tenant entity that has a flip arrangement. But if you've got a flip arrangement, okay, and you have a tax equity investor, there's a very good chance that the HLBV rules are going to apply. Okay. Now, it's a fairly complicated area of gap guidance. And as a result of that, you can, many different accountants can read it and come away with sort of different interpretations on how to apply it. So for years, there's been some inconsistency in the marketplace in terms of how different accountants even think it should be applied. Fortunately, though, in recent years, we've seen a lot more consensus sort of gelling around how to apply HLBV. Okay. And so, big picture, what you do under HLBV is you're supposed to pretend at the end of your reporting period that you're selling the partnership's assets for their gap asset value. That's your hypothetical sale price. You compare your hypothetical gap sales price to the adjusted basis of your tax assets. That suggests what your tax gain is on a liquidation. You look to your partnership agreement to see how your partnership agreement says the partners are supposed to allocate income and loss. You allocate that hypothetical gain in accordance with your partnership agreement. That sets up what your capital accounts are, and then you look to your liquidation provisions of your partnership agreement, and then you basically apply those liquidation provisions. And what you find out there is it tells you how much each partner would get in terms of liquidation proceeds in this hypothetical liquidation scenario. Whatever it says that the non-controlling interest or the redeemable non-controlling interest member would get basically becomes their ending gap capital account at the end of the year. And then you would share earnings in order for their non-controlling interest member gap capital account to equal that balance that you calculated doing that hypothetical liquidation analysis calculation. I just explained that in about as simple as a way as I could possibly think of, and it's still pretty confusing, I'm sure, for folks. Okay. Now, what I'd like to say to folks is you don't need to be as intimidated by HLBV as maybe people were in prior years. There is a lot more consensus here. There's a lot more understanding on how to apply it. And if you find yourself in a situation where you need help, reach out to us. Again, I plugged in Nick Ives earlier on right of use assets. We've got folks, Josh Morris, Nat Ang, several others here at the firm that run a lot of HLBV calculations for clients. So feel free to reach out, and we can help you understand it and apply the rules in a manner to sort of close out your books efficiently.
Thank you for that, Tony. It is interesting how HLBV has a frightening aspect to it. And part of it is just that it seems so odd in the sense that you think a partnership has income and loss, and you look at the partnership agreement and you allocate income and loss that way. You would think for GAAP purposes, you would allocate out the income based upon sharing versus all the rest. And that would be your earnings for the year. Just that it's kind of like a top down. You have income, you allocate it out, you get your
Right.
share. And this is almost backwards. This is sort of saying, we're going to reverse engineer your earnings for the year. We're going to look at, if we liquidate it at book value at the end of the year, this is how much you would get. Compare that to the beginning of the year. What's the difference? That's your earnings, which definitely seems backwards from how you would generally sort of report. And I understand the reasons why, so it reflects the economics and all the rest, but it definitely, is a next level away of income and loss allocation.
And the guidance really comes from the real estate context of, partnership flip type arrangements on
Right.
real estate deals. And I could sort of see how it makes more sense in that context. But then there isn't other guidance that's more on point here for these renewable energy partnership flip transactions. So unfortunately, you know, because there isn't better guidance, you're sort of forced into using this.
Right.
So, but it's frustrating. But I think the big takeaway here is it used to be very confusing because there was a lack of consensus. I think to just try to help put listeners' minds at ease here a little bit. The one good thing we've got here with HLBV is just much more consensus,
Right.
much clearer thinking. And we've been able to get clients set up with better we've helped them be able to put together better templates for them to apply it on their own as well.
Once again, something else you want to be thinking about before the end of the year, so you're prepared for their audit season next year. So the first three items have all been gap related. So this one is GAAP and tax related. So, GAAP is different than tax. So if you could share with our clients what GAAP and tax differences you often find clients aren't as sensitive to.
Sure. So for tax purposes, the IRS allows you to depreciate your renewable energy facilities over a much shorter period than you usually do for GAAP, right? So for GAAP purposes, our clients, they want to maximize earnings. So they want to depreciate their assets over the longest period possible to have the highest amount of earnings. Well, for tax purposes, obviously it's the opposite thinking. You want to maximize deductions and depreciate things over the shortest time frame allowed permissible. And so our clients, when they're doing the year-end books and records, many of them will depreciate things for tax purposes. They use a shorter life, and they might forget, they may not do their GAAP accounting books and records. They might use tax books and records or accounting policies that align much more with your tax rules. Okay. And so if they're booking depreciation at all, they might be using their tax depreciable life. Sometimes our clients think, okay, we're not even going to book depreciation before year end. We're going to wait and work with, our accountants to help figure that out. And so from a timing standpoint, I say just reach out to us. Let's have this conversation in Q4 as opposed to Q1. But anyway, depreciation, amortization, for amortization purposes, right? Organization costs is a cost that's oftentimes treated the same. Our clients oftentimes treat them the same on their books and records, but in reality, for GAAP and tax, they're different. For tax, usually you amortize org costs over 15 years. For GAAP, you expense them in the year that you incur them. Syndication costs, that's another one that's confusing for clients. Many clients expense them, but really, they're not really an expensed item. Syndication costs aren't. And then again, another common one are grants and rebates, right? A lot of times our clients just book grants as income, top line revenue. Okay. For GAAP and that, for GAAP purposes, they fall under a different set of accounting standards called, International Accounting Standard 20, which requires you to either defer it as revenue or reduce the asset that gave rise to the grant. So that's another common one.
So I will say, Tony, you're a very gracious guest because earlier when I was talking about the value of losses, I think I might have mentioned expensing the asset, and some sharp listeners probably said, well, you don't have 100% expensing. You used to have 100% expensing. That gets phased out 20% a year. So I do want to add that clarification. And you don't need to be so gracious next time. You can feel free to correct me. So let's go to number 5 of our post-placement service considerations. We're going to move past GAAP in federal income tax issues and focus on state and local tax issues. I know that's something that can really catch a lot of clients if they're not focused during their forecasting phase on state and local tax implications. So at a really high level, if you could share with our listeners what sponsors should be aware of with respect to state and local tax issues, particularly during the operations phase.
Sure. So I think a non-resident withholding, okay, and I think a depreciation. And so, states don't oftentimes mimic the same depreciable lives that are used for federal purposes. And so as a result, your state taxable income and loss can be very different than your federal taxable income and loss. If you have positive taxable income at a state level and you have a non-resident partner, oftentimes the state requires the partnership to withhold income taxes on behalf of that non-resident partner. Oftentimes, states, though, will say, generally speaking, even though we have this non-resident withholding requirement, many states allow the non-resident partner to provide an affidavit, basically, to the partnership that says, look, if in the event there's positive taxable income at the state that would trigger non-resident withholding, I agree to pay those taxes at my level. Okay. And if that partnership gets that investor to provide that non-resident affidavit, it can alleviate the partnership from having to withhold taxes on behalf of the partner. Not every state allows for affidavits. Not all states even require non-resident withholding. But I can tell you this, it's not something you just want to be dismissive about. You want to give it some consideration. And usually the tax equity models that are run based on federal income tax basis rules, not federal and state tax basis rules. So the models themselves don't oftentimes project out what the state and local income tax differences are going to be. Okay. So again, it's a good thing to talk to whoever's preparing your tax return, reach out to us and say, look, who's preparing our tax return? Can you help us feel better about our state and local taxable income? Because if we need a non-resident affidavit, we want to start having those conversations sooner rather than later. And if an affidavit isn't available and we need to plan for a non-resident withholding, we also want to factor that into our year-end budget.
And I would just note that if there is a waiver allowed, there may be, there's deadlines, processing times, it's of that nature. So if you think you're going to be eligible for a waiver, you should be seeking the waiver as early in the process as you can. And we talked about the state, but one thing that really seems to creep up is the concept of local tax issues. So maybe you could give some examples of local tax issues that can kind of creep up that folks may not be thinking about.
Sure. And this is where I love to give plugs to my colleagues at the firm. So my partner, Tom Bowman, and his colleague, Reza Kareem, uh, do a lot of state and local tax consulting for clients, especially renewable energy clients. In terms of local tax issues, you can have local personal property tax issues, real estate tax issues. A lot of times clients will call me, when we're running the model and I'll say, okay, what are you assuming for state and local taxes? And they'll say, oh, there's an exemption. There's a local exemption. And I'll say, oh, really? How sure are you about that exemption? Because most states, if you're putting a facility in that town, in that locality, if that facility has any sort of cost to the town in terms of facility services and whatnot, usually the town wants to recover some of that in some manner,
Right.
whether it's through some sort of personal property tax assessment or through a pilot agreement, payment in lieu tax agreement. And so I think sometimes our clients just kind of lull themselves into some sort of a bit of complacency, assuming that their deal is not going to be subject to either personal or real property taxes in the town, or that maybe some pilot agreement isn't going to be enforced in place of a property tax exemption. I wouldn't be so dismissive with your understanding of state and local tax issues. I'd really sort of double check with the town or double check with us here at the firm. And again, Rez has done a lot of great work for our clients in terms of peeling back the onion a bit and sort of looking at the different layers of taxes. But I would say state and local, it's the personal property tax issue that I think gets overlooked a lot. And then transfer taxes. I forgot to mention transfer taxes. If it's a development deal and you sell your partnership, while it's still in development or construction, some states or localities impose transfer taxes to buyers and sellers.
And how often do you see gross receipts taxes?
Gross receipts tax, I'm thinking of California in particular, but you can have gross receipts taxes as well.
Yep.
And so, yeah. So
And that's really why we talk about these issues. As I noted at the beginning, these are the times when the issues hit, but these are all issues you really want to incorporate into your financial model. You don't want to be finding out there's a gross receipts tax or some other additional taxes now after you've negotiated sharing ratios and all the rest, because that can lead to a result that wasn't intended by both parties.
and those results can be meaningful. So again, the models are almost always set up inherently on federal income tax basis method rules, and they
Right.
oftentimes don't expand the scope into state and local. But depending on the state you're in, it's worth considering whether or not you want to do additional analysis on the state and local tax front.
So thank you, Tony. Thank you for covering those 5 issues. And before I let you go on the main part of the podcast, are there any other tips you wanted to share with our listeners?
Year-end reporting. Let's see here. Look, the IRA is the Inflation Reduction Act. People are still looking at whether or not their deals meet domestic content. They're looking at transferability issues. The structuring is evolving quickly out there. Just reach out to us on deal terms. Okay. Reach out to us if you're curious what the market bears out there for transferability terms or partnership flip structures and so forth. Reach out to us. The market's changing very quickly and we're staying on top of it. So
Thank you for that, Tony. And I'll also note to our listeners that Tony and I did co-write the Washington Wire. They'll come out next month in November. And we talk about a lot of investor considerations, different structure types and the rest. And that's also a preview of our upcoming podcast. So thank you, Tony. And do please stick around for the off mic section of the podcast. Where I get to ask you some fun off topic questions to give you an opportunity to share some non-tax related tips and recommendations. And to our listeners, please be sure to subscribe to the podcast on your preferred podcast platform. We're on Apple Podcasts, we're on Spotify, we're on Google Podcasts and YouTube. And if there's someplace else that we're not that you think we should be, please let us know. You can also stream episodes directly from our website at www.novoco.com/podcast. I do ask that you give us a review. It helps other listeners find the podcast. And if you have ideas or suggestions for future episodes, please email us at cpas@novoco.com. So now we're on our off mic segment. So Tony, you've been a frequent guest of Tax Credit Tuesday. So a lot of the questions that I've already asked of you, my typical questions. But I did note in the introduction that our Novogradac 2023 Fall Renewable Energy and Environmental Tax Credits Conference is coming up in 2 weeks in Washington, D.C. on November 2nd, 3rd. So for anyone who's planning to attend our conference or visit DC on their own at some point, is there a place in DC you'd recommend they see? It could be a landmark. It could be a great place to eat or drink, or just a favorite spot you like to visit.
Okay, great question. So, our conference is at the Park Hyatt Hotel in DC. About 1 mile from the hotel is the White House. And so whenever I go to now we have our renewable energy conference right around the first week in November every year. Well, there's oftentimes a big election that's taking place around our conference. And so one thing I love doing in DC, especially that time of the year, is I love to take a walk at night and go down to the White House and just sort of feel that connection with, when you look at the White House, you can't help, it's such a symbol of American democracy, and you just really feel that connection when you're kind of right up close to it. So I love doing that. And many years ago, I've been hosting this conference for, I don't know, over 10 years. But I remember one year I was with Stephen Tracy in DC, and it was the night Barack Obama was elected president. And we left where we were having dinner, and we walked down to the White House, and it was just a particularly memorable moment during that time because there were so many people out in the city that night, sort of recognizing that moment. And ever since then, I've made a point to go back and sort of walk by the White House during our conference.
Wow, very moving. So given that you'll be going to DC soon, is there a useful item you always pack on a trip, and why?
Okay. I always pack my slippers.
I was not guessing slippers.
So, yeah, I always pack my slippers. It's like a creature comfort from home. Home is my favorite place to be, and so I bring those with me, and it helps me feel a little bit of a connection to my home and my family.
I like it. I like it.
So,
If you were to ask me that question, I would say it's less what I pack for a trip. It's what I don't unpack.
okay.
So I've got as listeners know, I have a suitcase filled with a second of all the various items that I need. And if I don't unpack it, I don't forget to pack it.
They I love it. I love it. All right. So, Mike,
Yes.
I've been a guest on your podcast many times, but I've never asked you a question in the off mic section.
Okay.
And so if you wouldn't mind, I'd love to ask you a question. And this came to me from my daughter.
Okay.
Right. So my daughter's interested in business and finance, and she said, "Dad, I want to read a book um, that's, the theme being sort of business leadership or business success." And she said, "Do you have any recommendations?" And I said, "You know what?" She asked me this over the weekend. I said, "I'm going to be on a podcast with Mike on Tuesday. He's known to be a bit of a voracious reader, and I'm going to ask him for a recommendation and see what he says."
So there's a lot of books that sort of come to mind. I will say for those in accounting, this book it's certainly kind of a bit dated, but it is the Robert Half Success Guide for Accountants. And it's definitely dated because some of the techniques and such aren't really applicable in this day and age, but it was something that I read 35 to 40 years ago. And I found it really helpful. That said, I haven't read it in a while, and I can't really say how well it's aged. So I am going to go back and reread it, see how well it's aged. And maybe we need to reach out to Robert Half, the company, versus Robert Half, the individual, to see about getting it updated. But that's pretty narrow. To be more broadly about sort of building a business, I really like the book by Jim Collins, Good to Great. And part of it is maybe it's my economics undergrad, my business degree from Cal, but it really talks about, some of the keys to success of a business. And they have this concept of a flywheel where you do something, you get it to work once. And once you get the wheel turned around, it can be hard to turn it the first time. And then the next time you turn it, it's a little bit faster. And then you just get that flywheel going. So the concept being, you need to perfect the process and keep improving the process to get the wheel kind of going sort of faster and faster, if you will. It also talks about how when you're kind of building a business and thinking in new areas, you take like rifle shots. You don't make a big bet. You take, rifle shots. It also talks about how in successful businesses, a lot of the decisions just seem like the natural choice. It wasn't like some great vision, but like that was the most logical next thing to do. It downplays the importance of any one person. It kind of downplays the notion that some big leader had some big idea. It is much more on the process. And it says sort of good to great because it basically took a couple of companies that were similar, and they basically took several in a bunch of different industries, took two companies that at a certain point in time were roughly equal, roughly equivalent, and one did really well and one didn't. And that basically goes in and he's a professor and had, students, all those doing research, and they try to identify with all these different sets of companies or these matches, what was for those that went from good to great and those that didn't, what were the unifying themes? And they distilled them and all the rest, and they came up with this theory about what separated the good to great companies from those that weren't good to great. So I definitely would recommend that and it's super, I think it's very analytical. It has lots of good wisdom. And you probably even heard me mentioning some of those themes in our various partner calls.
Yeah, indeed. No doubt. No, thank you very much. That's great. I love those recommendations, in particular the good to great, because I think they can be applied in many different sort of situations.
Very good. Thank you, Tony. I'm looking forward to having you back in a few weeks on another Renewable Energy Project Finance Series episode. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novaco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novaco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.